Hi guys. Today we will analyze Goldman Sachs stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. Both the long and short-term trends are negative. It is better to avoid buying stocks with negative trends. Strong support levels are around $300 and $274. Next strong support levels are around $250 and $214. Strong resistance level is around $325. Next strong resistance levels are around $349 and $375. In the last month the stock has been trading between $294 and $347 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 2.9 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since October 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Valuing financial institutions. Understanding why financial institutions are different from traditional real sector companies is key. Banks function differently than traditional cash flow-driven companies. Traditional companies create products to make money. The products of banks are money. Banks are highly levered and they do not reinvest debt in the business and instead use it to create more money. They make money via interest. So, they view debt and interest differently. That's why, our favorite discounted cash flow valuation method doesn't work for banks and insurance companies. Intrinsic values calculations. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. The excess return model. This approach is used for financial institutions where free cash flow is difficult to estimate. Then, we will use valuation based on earnings per share, EPS, 5-year average PE ratio and expected growth rate. First model. Excess return model valuation. This spreadsheet contains some financial data that we will use for the stock valuation. In this valuation I will use margin of safety. 30%. Once we actually figure out what we think this stock is worth, we are only going to buy the stock if it gets 30% of what we think it's worth. It gives us a big margin of safety if our predictions are wrong. In other words, when something is worth $1, I want to pay only 70 cents for it. I want to be conservative with financial institutions. So, my margin of safety is 30%. According to our formula, the fair value of the stock is $979.91. When we apply the margin of safety to that value, the fair value of the stock would be $685.94. That's the price that I may want to pay for this stock. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for Goldman Sachs is 51.52. Minimum rate of return. I will use 10%. Because when we invest in individual companies, we are looking for a higher return than the S&P 500. For Goldman Sachs, analysts forecast growth rate around -5% per year in next 5 years, and future PE around 8. I will use 3 different scenarios for Goldman Sachs Company: bad, average, and good. First scenario. Goldman Sachs will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, -2%. Future PE would be low, 6. In this case, the fair value of the stock today would be $109. Second scenario. Goldman Sachs will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 0%. Future PE would be average, 8. In this case, the fair value of the stock today would be $175. Third scenario. Goldman Sachs will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 10. In this case, the fair value of the stock today would be $261. As you can see, today the stock is overvalued, $308, even if we expect the company's high performance in future. The fundamentals are decent, but the revenue is expected to decrease by -5% on average over the next 5 years. Based on that pessimistic forecast, the stock looks overvalued in my opinion. Also, the stock has been in a downward trend since October 2021. The stock can go lower before it recovers. I may consider buying the stock for the dividend, 2.6% yearly, when the stock drops below $260, and when it shows signs of reversal. Company's strengths. The Goldman Sachs Group is an American multinational investment bank and financial services company. It provides investment banking, securities, and investment management services to corporations, financial institutions, governments, and high-net-worth individuals worldwide. It is considered a systemically important financial institution by the Financial Stability Board. The company's balance sheet is sound, its capital investment decisions are fair, and its capital return strategy is appropriate. Goldman intends to focus on 4 areas for growth: transaction banking, third-party alternatives, digital consumer banking, and wealth management, which it believes will help it expand its addressable market. In digital banking, Goldman sees a 5-year opportunity for $125 billion in consumer deposit balances, and growth to more than $20 billion in loans and credit card balances. So, the company has launched its Marcus platform for deposits, and the Apple Credit Card, and is pursuing additional products and partnerships. In wealth management, Goldman sees a 5-year opportunity to add 30 corporate clients annually, as it integrates the United Capital acquisition and launches new Marcus products. The company's return on equity of 18.9% is in line with the rest of the industry. The industry average return on equity is 17.6%. Its profit margin of 31% is in line with the rest of the industry. The industry average profit margin is 24%. Risks. Revenues were down 27%, hurt especially by lower investment banking activity, as geopolitical events produced a risk-off quarter. Consensus expectations continue to call for a considerable earnings decline in 2022, as capital markets revenues come down from record highs in 2021. Goldman is broadly exposed to global economic and financial market conditions, and has also dealt with a wide range of new regulations resulting from the financial crisis. Goldman Sachs has been too slow to adapt to the current regulatory and capital markets environment. Other banks were quicker to materially change their operations. While management has taken steps to improve disclosure, investors must remember that quarterly results are volatile and difficult to predict in many parts of Goldman's business. The company has been criticized for a lack of ethical standards, working with dictatorial regimes, cozy relationships with the U.S. federal government via a revolving door of former employees, and driving up prices of commodities through futures speculation. The company has a return on assets of 1.2%. This is below the industry average of 5.4%. The revenue is expected to decrease by -5% on average over the next 5 years. Based on estimates for the next 5 years, Goldman Sachs will show a small growth in earnings per share. The EPS will grow by 5 to 10% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.